Exactly. If a property will not cash flow with a 20% down, should you consider paying more down? Also, is it better to have 4 properties financed or one paid off? So this is a personal preference, 100%. The latter part is, at least, whether or not you should purchase a property at 20% down that doesn't cash flow. I would not do that. Do not buy any properties that don't have positive cash flow on long-term financing. That is asking for some trouble. So don't do that. If it means passing on that deal and continuing to look for another one, you can do that. Warren Buffett has this quote, uh, and I don't know much about sports, especially not baseball, but it's something to the effect of, like batting averages are calculated based on, what? I don't know. His whole point, I'm just going to summarize it, is that he doesn't have to take swings. Nobody is forcing him to swing at things that he might, in fact, miss. So he's got the ability to only swing on deals that he knows are going to be a home run. Nobody's forcing you to buy this deal. If the property doesn't cash flow and you don't want to put more than 20% down, then don't do it. It's not worth it. Similarly, I would argue, depending on your age, that plays into the leveraging aspect. If you want to make the most amount of money from a cash flow perspective, and you are inherently uncomfortable with debt or leverage, then buying one property outright will be a better option, because you're going to do less work. You're going to have the most amount of cash flow on that property that you possibly can, because you don't have a mortgage payment. So, however, keep in mind there are 4 main ways of making money in real estate investing. You've got the cash flow, you've got the tax benefits, you've got the principal pay down, and you've got the appreciation. So if you have a property that is paid for free and clear, you're going to have the appreciation and you're going to have the cash flow. However, you're not going to participate in principal pay down because there is no mortgage, and you are not going to participate in, no, you're still going to benefit you're still going to benefit from the tax benefits. So tax benefits, cash flow, appreciation, principal pay down. So you're not going to participate in the principal pay down, but you're still going to get the appreciation, the cash flow, and the tax benefits of that one property. However, if you have 4 properties that are leveraged, you're going to still be able to, assuming the cash flow, you're going to be able to take advantage of the cash flow. You're going to have 4 times the appreciation because all 4 assets are appreciating. So your cash flow might be lesser on the 4 properties than on the one, per property. Hopefully, with 4 properties, you're making more on a monthly basis in cash flow than you would be on the one. Your cash flow on any given property will be less than the one that's leveraged, because, you have to consider that mortgage. So you're going to get 4 times the appreciation because there's 4 separate assets. You're going to get 4 times the tax benefits because there's 4 separate assets. You're also going to be able to write off that interest that you are paying on a monthly basis. And you're going to get the principal pay down on 4 different assets. So from a long-term perspective, if you, kind of zoom out 30 years, you're going to have more of an impact on your balance sheet from having 4 properties that are leveraged than the one property that's free and clear. However, again, I've said this before, if it is your personal preference, if you are somehow uncomfortable with being beholden to 4 different mortgages, if debt somehow makes you uncomfortable, if debt somehow keeps you up at night, then do not do it. You got to protect your sleep. You do not want anything in life to keep you up at night. So don't do it. If you're uncomfortable having loans, don't do it. If you're comfortable with it, do it. But, there are just as many different ways to make money in real estate investing as there are people investing in real estate. I've got one good friend who's got a couple hundred single family homes, and he started buying them in the late 80s, early 90s, and he just did them one at a time as he had extra funding. So across his entire portfolio, he might be at about 30% leveraged. He's comfortable with that. He's happy with that. He has met all of his family's needs. All of his kids have good heads on their shoulders. They're going into the business now with him. So different strokes, different folks. I think that was good. I think that was a really good question. Thanks for asking it. Thanks for watching that clip. I thought that was a good question. And I think you can ask good questions too. Join us every Friday morning at 8 a.m. Eastern Standard Time for a live stream Q&A where we answer plenty of questions just like this one. In the meantime, consider subscribing to the channel if you want more of this content. And if you want to increase your deal flow, analyze properties better, and help me feed my family, click the link below for a free 7-day trial of PropStream.